Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome. I'm Guy Allard.
Welcome to the show. I'm Victor McClure. We developed this show to answer your financial questions. Someone asked me the other day, we've been doing this show and been on the radio for, 20 years, 30 years or whatever. And they asked me, why do you call it the CSI show? Well, back then, it was a play on, CSI, Crime Scene Investigation. Right. And we were going to say, well, we take investments and investment strategies and boil them down to getting the fingerprints.
And investigate them like a crime scene. That's right. And some of them are.
That's right.
Unfortunately.
Well, since the CSI stuff isn't as prevalent now, I don't use it anymore, but it used to be the CSI show, but that's what it was for.
Didn't they have 2 or 3 separate shows on at the same time? Like
CSI,
Miami and this and that?
They're actually pretty good, except they show those police stations. They look like state-of-the-art things, and I'm like, I've been to a lot of police stations over the years.
Oh, have
Not
you?
Not that way.
Oh, have you? Well, maybe we should talk about that a little bit.
My ex-wife's a cop. Let me explain.
Does the word fiduciary mean anything to you?
No, I've never been arrested, ever.
Okay.
But I've never seen one that's high-tech with this screen, with the computer, touch screen. I'm like, that's bull.
You picture it in California or something, wouldn't you? Or Seattle.
Yeah, they don't have that. Now, these newer suburbs of Dallas have some of the nicest ones you'll find. They still don't have that, all that fancy stuff. Oh, my gosh. We had a breath analysis because he took a breath on this quarter that we found 5 years ago, and we know it's him. I'm like, what? Well, that's what we designed the show for, is we do deeper, more in-depth research on investments and things like that more than anybody I know. I had a client bring me one 2 weeks ago, and I spent about 6 hours breaking it down to because trust me, when you're talking about a security, you got a prospectus. There's about 1 in 1,000 people who read a prospectus. I'll read it every single page.
Well, and their things are hidden. I mean, they had talked about it one time, the SEC, FINRA, whomever, about making, like your ingredients on your food when you buy your stuff at the store, it's all in one little box. They were talking about doing that with fees and everything right on the front page, so it was all collective, where you don't have to go to 4 or 5 different areas and separate expense and fees and management costs and all of that stuff. But they didn't get there.
Well, I saw a variable annuity, which I don't recommend those if fees are too doggone high. There are some low fee ones that aren't too bad. Yep. But the 95% of, maybe 99, the fees are ridiculous. And what they do is they have had laws change that make it more clear. They have to tell you how much in potential fees you could pay over 10 years. It's usually towards the front of the prospectus. The problem is people don't read the fine print right below it. I was talking to a person the other day. He goes, no, Victor, I was going to do $1 million in this variable annuity, and it shows out right here, over 10 years I could pay us $6,000 in fees. You read below that in the fine print, it says that's per 10,000. So he goes, wait a minute, per 10,000? I go, yeah, 600,000 in fees you could pay over 10 years. He goes, holy moly.
It's worse than that. Victor and I worked on a case together, still kind of working on it together, where we were comparing a decent variable annuity, low fee annuity, with a couple others in Vanguard and Jefferson Pilot, I think, was decent. Mm-hmm. But they have a fee, but they also have another column that says it can be as high as. Right. So if they're doing a 10-year projection on what your fees are, that projection's usually on the lowest amount, the current amount, but they can increase that. So you want to make sure there's some out there that can't be increased. This is the number. This will be always a number. It's a static number. And if you can get those, they're preferable.
Right. And it's weird because we called the people when researching this particular annuity. We called them and they said, no, it's all included. And I'm reading the prospectus. I'm like, it's not all included, but it was a 0.9 fee plus the fund cost.
Now, unfortunately, just because they say that, fortunately, it doesn't mean they're trying to deceive you or be deceptive. How many times have you called?
They don't know.
Yeah, the phone company or the cable company or something. You're trying to get something justified. And, oh, no, that's the way it is, until you get high enough up the ladder when someone realizes that it's different. So they may actually believe that when they tell you that. They just haven't been there long enough. It's not their field.
It's just like my wife bought a car here just last week. and she bought an extended warranty. You want to get a warranty up to 120,000 miles. Well, this is a used car. It already had 50,000 miles, so it makes sense to get a warranty on it, right?
How much is a 50,000 mile Rolls?
Yeah. She goes, and they said remember there used to be the sales guy did everything, but not in the car business anymore. You get the financing
F&I,
people do
right.
everything. They're the ones that do everything. So basically they said, no, you already have 50,000 miles. It's 120 plus the 50.
So 170.
Yeah, 170. Even wrote it on the thing. I go, no. He goes, I know the contract says the other, but this is a legal contract. I don't care what you tell me. Well, he had to go to his boss. He said, oh my gosh, you're absolutely right. I've been telling everybody that for years. You can only believe the prospectus or the contract. Everything else is BS in my opinion. And like I said, this person was wrong. I said, I know it's wrong because I've got a client that owns one of the biggest companies that do secondary warranties on cars. And there's no way it's added on. It's in lieu of. So when the car gets to 120, which is 70 more, it's basically you're buying a $70,000 of coverage or 70,000 miles of coverage. Same thing with annuities. Same thing with stocks, mutual funds, unit investment trusts. There are little details that you really need to know. And I'm telling you right now, we've been doing this 30 years apiece. I would say a good 60-70% of professional advisors do not know what they're selling.
Just like you just said with the car guy. He didn't know. He wasn't lying or trying to lie. He actually wrote it on the paperwork. 120,000 additional miles. He didn't know better.
That's right. But that's what happens. We see it every single day. But that's what we do for our clients and our potential clients. We will tell you everything the advisor doesn't know or doesn't tell you. And that's how neither one of us in 30 years each have ever had a customer complaint.
No, and we don't want you to get the idea that we know everything, or at least that we think we know everything, because we don't. But the things that we don't know, we know where to. There's some tax things that'll trip you up every now and again, and we have to do some serious research. Have you ever tried to research something at SSA.gov or the IRS or any of those places? Holy cow, that's some heavy, heavy reading.
And we do that for our clients so they don't have to go through that garbage. Right. But we do that every single day, and that's why there was an article in a magazine was telling me, I added some to it. It had like, should you have a financial advisor or not? And remember, I'm of the school that if you have the time, if you have the expertise and the nerve, how about put it that way, there is nothing wrong with managing your own money. Nothing. Any advisor tells you you're an idiot for managing your own money, I mean, I get it. They'll use it. Would you operate on yourself? Well, you're not really operating. I mean, that's a little extreme, don't you think?
It demonstrates the point well.
Oh, it does. And I think, obviously, I've been a financial advisor forever. So I think you've been it. But we're going to go over a few of the differences, okay? And if you're not getting this kind of service, call us because we will give it to you. And even then, let's say your advisor right now is your brother-in-law. You can't leave him.
No.
Well, now you can give him a few things. Hey, here's what I need from you.
And point them in the right direction.
If you're going to pay the fee, whether it's a 1% a year or a commission on something, get everything you should be getting out of it.
And one of the things that allows us to do this, because everyone wants to be objective and not subjective, is the fact that we would be what I would call a boutique firm, in as much as we're not captive. We're not working for one of the big names and where you have the Monday morning meetings and they tell you what needs to be sold and why it needs to be sold, which is usually a high profit margin for them. We can choose anything from any group in the universe of investments pretty much and make it work for the clients opposed to trying to force a round peg into a square hole.
And I've never, in all these 30 years, found a proprietary product. Because, by the way, 95% of all investment products are available to everyone.
Right.
95%.
That's right.
The 5% that aren't are proprietary. Usually it's a bank. A bank is actually going through Fidelity, but they'll private label something. And they're never good. They're always worse than the one that's available to the public.
I can think of one exception now. I would have agreed 100%.
Vanguard is the only one I know.
Well, Vanguard's very good, but think about that. Even it's an annuity.
Right.
Does it help you? Security benefit when it first came out with their lifetime income rider in the day was impossible to beat.
Yeah, but everybody could get appointed with them. It wasn't an issue.
Well, you had to go through their FMOs, their marketing organization.
At that time, their FMO let everybody in. So yeah.
Yeah, but if you weren't with them, you couldn't have the product.
That's true. But the number one thing, having a financial advisor or not, and I'm just looking over the Fidelity plan right now. That's the second one I've looked over. And I can tell you the differences. It's pretty detailed, but there's differences. But people that have an advisor, let's use that first. They have an advisor. They don't have a written retirement plan. Only 16% of those people feel prepared for retirement. Now, they've got it. They might have been with the advisor for 30 years, but there's not a written plan. There's, oh, don't worry, I'll take care of you. He always has taken care of you in your mind. Right?
We'll wait till we get a little closer.
Right.
Well, wait a second.
16%. Now, if you had a written retirement plan, 67% of pre-retirees feel prepared for retirement. That's a big difference. And the problem with managing yourself, like I said, I think there's nothing wrong with it. But only 6% of the public feels prepared for retirement when they're doing it themselves. Even though, I've been doing this a long time. And a lot of times people say, no, I'm good. Ask them, really? Well, I don't know. But think of it. You can turn yourself from 10% prepared to 70% prepared by having a written retirement plan. Now, it's important what that retirement plan is based on. Like a lot of them, from the big wirehouses especially, you got to read deeply into them. You got to really dig all the, the fine print. But they'll be based on an average market return. Now, let me tell you what the average stock market has done the last 100 years. It's about 10% a year, okay? But in the old days, 5% of that was dividends. The other 5 was growth. So your actual growth has never been 5. The problem is right now, dividends are less than 2. So if you get the same growth, you're only talking about 7. Now, keep that in context. The last 17 years, the market's only made 4.06%. Even with this giant year we had for 2017, maybe 4.2%.
Yeah, and this giant year really probably isn't as giant when you look at the average for the whole year. So as you get to year end and you start auditing your accounts, you need to take a look at what the S&P, because that's the benchmark, right? 500 stocks, it gives you diversity. See what it did. Allow yourself a little fudge factor, right? Because you're going to probably be paying some fees, and then you can kind of measure up your guy. And now, if you're in a 50-50 portfolio, right, you're 50 years old, 50's in the market, 50's safe, you can't take that number on your whole portfolio. You have to take it only on the 50% that's in the stock market. But gauge him. How has he done in this bull market for you?
Well, think about it. We have a market that's only made 4 with no fees, which nobody made for during that period. They're using 10 for your retirement plan.
Right.
Also, do you know what 10-year bonds they're using? That is average about 7% a year, which is now like 2 to 3. And so it's not realistic anymore. We're in a lower interest rate environment. The world has changed since 1980. I don't care what happened since about 1990, honestly, with interest rates.
Obama said 1% growth was the new norm.
Right.
I guess he was wrong.
So think about that. You don't want a plan. What you want is a written plan that isn't depending on the stock market making 10% and your bonds making 7% when we haven't had that in 20 years. That's what you have to look at. But what they'll do is they'll throw a below average in there, a really significantly below average. What are they using for that? 5 instead of 10, maybe 4 instead of 7 on the bonds. It's still lower than or higher than we've actually returned the last 17 years.
That's right.
And so that's why you have to have a plan. First, you try the dry run. If my stocks don't make anything, am I eating cat food when I'm 80, right? You dry run. Well, then you put a more realistic number of a stress test. You want it to be on the low end on purpose. Because remember I said the market made 4% for 17 years? The average person made 2%.
Think about what you learned when you were a kid, what our parents taught us. You plan for the worst, but you expect the best. You're always optimistic. But you don't plan for the best. Because if the best happens, as we talked about, there is no problem. Plan for the worst, expect the best.
Because think about that. If you did plan for the worst and the average market hits you, you're fine.
That's right.
What if you plan for the average market and a low market, no market hits? You're done.
You're selling your house. You're downsizing when you don't want to.
So the number one reason, I believe, like I said, they've got some pretty decent online tools. Fidelity has one. Vanguard has one. But they're still giving you average market crap in a black box that you can't pull the returns out of that thing. And when you can, it's going on a Barclays index from so-and-so. And why didn't they use S&P? Because it was more favorable to the thing, that kind of stuff.
And keep in mind, statistics can be gathered in any way that the guy gathering them wants to. If you take out the crash of 08 and 09 and just run the numbers after that, when it came back till today, you're going to have a much higher number. So they can say, well, the market's averaged 12%. Well, it really hasn't. Right. Maybe for the last 9 years, but you got to take a downturn or a crash. And you had 2000, it did it again. So you can cherry pick the years consecutively to get that higher average, and they can build the case for you, but you need to know a little bit more, and that's why an advisor, someone that CSI, crime scene investigator, can go through and help you and at least point you in the right direction.
Like I said, I've got that engineer type brain. Remember, I was a nuclear chemist. It's all numbers to me. Numbers never lie. Everything else can be manipulated, or let's say I'll emphasize the benefits, but de-emphasize any of the negative if I say anything at all, right? But you have to have a big picture. And that's why number one reason having a financial advisor is, and this was a survey too, what was the number one reason you have somebody or don't have somebody?
Right.
A written retirement plan is the most important. Remember, we have the most comprehensive retirement planning software I know. You can change just about every single variable when some of them, almost all of them, have a black box as part of the assumptions. I don't want a black box assumption. I want to put assumptions in that I want. I'm going to make them stress them and see what happens. Because if I can live through a really stressed situation, then I can live through an average or great situation, right? Number two, the number two thing they said was to ensure they don't run out of money. That's what we talked about forever. Remember, we said, I think all of your bills should pay with a guaranteed income stream. You cannot deal with the sequential risk of taking money and selling stocks or bonds to pay bills. It's a death spiral. If the market, the first couple of years, first 5 years, if you have a significant downturn in the market, it wrecks the retirement.
And for clarity's sake, sequential risk is withdrawing money from an asset that goes up and down because you're deepening the downs, you're shortening the ups, and it absolutely kills what the average return would be.
Oh.
It's nowhere
close. And the answer to the people, like I said, Ken Fisher, I don't want to get a war with him. He's gigantic, but I'm just saying, he'll say that, well, you just got to spend less during those times. Okay, well, just tell the water company they can't get their bill right now because the stock market's down. It doesn't make sense.
Can't you use less water?
They said take out 3% and you'll be fine. Okay, if the market drops in half, now I got to take out 1.5%. That's exactly what they're telling you. The people that tell you never use an annuity or whatever, they're saying, yeah, what, you can't do that.
Which is counterintuitive to what not all the, but a good number of professors, Nobel Economic Prize winners say, etc. Of course, these professors aren't spending $1 million a month trying to advertise
the Mannish program or something.
That's right.
We got 4 Nobel Prize winners in economics, multiple professors that say, yes, absolutely.
Every time I say Nobel Prize winner, I've got to really catch myself and think about what comes out because I automatically want to say Peace Prize. But these are economic prize winners.
Nobel Prize in economics. And so number one is getting a written retirement plan reason to have an advisor. We think we have the best program. I can prove it, but I'll show you any other one, and I'll show you why ours is better, more comprehensive, because you have more. It's more of an open architecture system.
You've probably, if you've had anyone do one of these, you've probably had one done. We've done them before. We had a program that used to do the Monte Carlo scenario, and it's about 100 different lines on one piece of notebook paper, landscape style, all different colors, showing you all the possible different alternatives that might happen to you, and then what's probable.
Right.
It's very confusing unless you deal with those all the time.
Like a good one, they might say that you have a 72% probability of success. Some people will think, hey, that's pretty good odds.
So is that 28% means
you're going broke?
Fail?
You're eating cat food, right?
That's right.
And also remember, retirement is it doesn't matter if you're 40. I know some of people say, why are you always talking about retirement? Because that's the end game, the end goal, right? But no matter what it is, you got to ask yourself, do you want to base your retirement on probability or a guarantee? That's really, I think, what it boils down to.
If you have your expenses guaranteed in retirement, think about all the variables that you probably don't think about because you don't do this every day. What the market's doing when you're retiring and need the money is crucial. What happens if you retired in 08 or 09 and the stocks were down half? What if you retired when interest rates or when inflation was crazy high? I mean, there's all these things. What about the stocks and the investments that you're in? The dividends that Victor talked about, those are down now. If you planned on dividends, we've talked about oil and gas dividends were great for a long time.
Huge.
Now you'd have to be at about a third or a quarter of what you were before. So there's all these variables that you don't have to worry about if you plan to have your hard assets or expenses taken care of.
Right. Remember, call us if you'd like us to run a plan for you or just talk to us about any investments or strategies. Our number is 972-715-5555. 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. Number 3 reason people hire financial advisors, to protect portfolio principal. A lot of people know you can protect principal in a money market or a CD or potentially a bond. They don't know any other strategies. But what you do is, growth was the main objective typically till you get close to retirement. Now protecting the nest egg. People always ask me, what's the difference between a really rich person and a person that just has a normal, $500,000 or $2 million in the bank or whatever?
Rich people don't take risks.
Yeah, that's right.
They're all in munis.
Rich people, they tell me totally different. Well, the guy goes, well, I need you to be this benchmark and do this, blah, blah, blah. Rich people say, hey, you make me 3 to 6% and you never lose the money. That's all I care. Don't lose money. Number 1 is don't lose money. Now, what do they know that other people don't know? They just know returns go up and down or whatever. You start losing principal, it's done. You can't be taking big losses in retirement.
And the old adage was, from the College of Financial Planners, you don't chop the tree down to harvest the fruit.
That's right. The next thing they hire, minimize taxes. There's a lot of tax strategies that you can employ in your retirement and your pre-retirement. Sometimes people don't realize I got a person with $1 million, they got $900,000 in a CD paying them 1%. They're in the 39% tax bracket, so they're making 0.6. We can change that to 4 to 5, make it tax deferred, so all that interest compounds upon itself. So it'd really be like a CD paying 6 or 7.
Yep.
But there's a lot of things like that. Also, we do Roth conversions for some people. These are only done for people that have max tax bracket now, and they continue to be max tax bracket. But that gives you pools. We can turn some kind of Roth IRAs into an income stream that can pay you 10 times what you put in it, tax-free. And so those are things that you have to look at.
And when you're, just a brief note since we're on those, when a Roth is inherited, it now becomes subject, again, to the RMDs and all of that it forgoes when the original person has it.
All right. Also, here's number 5 of why people hire a financial advisor. And if you have one, if you're not getting all these, you need to call us. But giving a more realistic picture of what you can afford in retirement. Because a lot of people, I'm telling you, don't have the picture. I've got guys, all right, I've saved $700,000. I said, well, how much do you need in expenses? $150. I'm like, well, how am I going to get $150 out of $700?
Even $100.
Well, my other guy said they can do that. I said, well, the other guy's either crazy or ignorant.
Based on the market average of 11% a year. What are you talking about,
right.
Victor?
I go, if you want to do the average, just take your portfolio times 15% a year. Of course, you'll be fine.
Yep.
It's a worthless piece of paper. It's a worthless exercise, but you got to do it the right way. So a realistic picture, a sounding board, don't underestimate it. Just make sure you're not paying ridiculous fees. Don't pay 4% a year, 5%, even 3% a year. You're starting to get ridiculous because I think advice is worth it. I think having a professional is worth it. Paying too much for it's never worth it.
No, and they do say when you're projecting what your expenses will be in retirement, to take 80% of what you need now while you're working. I always say take 100. You give yourself a 20% margin for error if you do that.
Because you have more time to spend money now.
That's right.
I only shop usually
and it doesn't
on the
reduce
weekends.
the expenses that much.
No.
What, dry cleaning, a little bit of gas? I mean, it doesn't.
And you got a realistic assumption of what happens if one of you passes away. I'll see people use 50% of the expenses. I go, wait a minute. So one person passes, you still got the same water bill, electric bill, and all that. 85% is a better number. 85 is what you'd use if one of you passes away on the expenses, because some of them are set anyway.
Right.
And so just a little less food, travel money, things like that. It's about at it. It's about 85%. Here's number 6.
They may need more money for dating.
That's right. Helps maintain perspective on events and trends. That's another thing. Here's a perspective. Market's gone up like crazy. I've made a heck of a lot of my stock accounts. My clients have too. It's been fantastic. That's 9 up years in a row. If you ever looked at the market for the next 10 years, you have never had a 4 or 5% a year for the next 10 years, ever. Because then your average would be like 15% a year, right?
Yep.
So anytime you have a long bull market, the longer it is, the worse the next 10 years are going to be. There's 50 professionals came out and said, ooh, it's going to be lucky to make 4 for the next 10 years. That's just the way it is. I don't care if you believe you're the biggest Trump supporter in the world, you think the market's going to go. It will, and lowering taxes will help. But a lot of that's factored in, and it can't go. It's 9 years in a row it's gone up. 9. Now, when's the longest bull market in history? This is it.
Yeah.
And the 90s were pretty bad. The early 2000s weren't too good, right?
That's right.
The 90s. This is longer than the 90s because 2 of the years in the 90s didn't make it.
Ann Coulter was on Lou Dobbs earlier this week, and it was funny. You know, she's a right conservative person, but she's not a Trump. She hasn't drank the Trump Kool-Aid.
Right.
And he was talking about the trillions of dollars that Trump's created in the bull market. And she said, Lou, I wish you'd quit saying that because the market is going to go down at some point, and you're going to have to retract it.
Right. So maintain perspective on events. And also, number 7, why people have financial advisors. You remember, I'm a proponent of managing it yourself. There's just a lot of things that you're missing out on potentially. But it helps you plan and maximize Social Security. Social Security, what are there, 7,000 ways to take it or some crazy number? I don't remember the number. But your advisor should help you, show you exactly how to maximize Social Security. You don't do it that simplistic way. Everybody goes because they forget cost of living adjustments. They'll say, all right, well, I'm getting 1,000. I'm going to take it at 62 because it might not be there when I'm 70. And I don't break even until 74. Well, nobody in my family lives past 74.
All right.
So they do all those exercises, but that's simple math. When you put cost of living adjustments back in, it brings it down 4 or 5 years. And the last 30 years, life expectancy of a male has gone up over 30%. And what is it going to be in 30 years when you and I are in our 80s, right?
It's going to be longer.
That's right. So you got to plan that way, and that's what an advisor helps you with. So help plan and maximize Social Security. Here's number 8. The ability to update and optimize retirement plan when life events happen. And when they occur. This is the thing I see a lot with people self-managing their money. And there's a divorce. They do it the same way. There's other things you have to have that written plan. You have to adjust that written plan. So I have many clients that have got divorced over the years. We split up the plan and we do it exactly. And it's weird. Normally they'd have expenses of the same. You think you can cut them in half. No, because they're getting different domiciles.
Both
now,
are
right?
a little short, aren't they?
That's right. So you got to go the other way. A financial crisis happens, a death, one of you pass away, or incapacity, one of them goes to a nursing home. The problem is you've planned this whole thing out, and now you've got another $5,000 to $7,000 a month going out, and you still got your house to pay for, still got the same water bill, electric bill, but I got another $7,000 a month going out for my spouse that's in a nursing home. You got to be able to plan for that kind of stuff. Also, number 9 was offer investment products that aren't offered through anything but financial advisors. Believe it or not, there's a huge number of investments that are only offered through financial advisors. I know somebody, a skeptic would say, no, yeah, that's the ones you guys are pushing for commission. I get it. They're not available. You know, some things are, like Vanguard has a really good wide array of things.
They do.
Really good. So does TIAA
You
Crest.
still need help to get in direction on when you use those.
But I'm telling you, call customer service in one of these places. You're not getting a licensed professional typically. It's a dang clerk.
And you don't know how long they've worked
No,
there.
they don't know anything. You know.
Where they graduated on the curve.
And here's the last thing. You know, you have a sounding board for life changes.
Isn't that your wife?
Yeah, that's right. Large purchases, investment strategies and products. You know how many times customers go, I went to the seminar. This is a dinner seminar. They got me a Ruth Chris steak. And this thing looked like the greatest thing since sliced bread. Oh, my gosh. He said, trust me, I've been doing this 15 years. This is the best you'll ever do. Why aren't we doing that, Victor? I do our research, hours of research on the product. It's horrible.
Life settlements was a real
Oh
big.
my
We
God,
had
the
many
life settlements
questions before they got into all the legal trouble.
We've been recommending against that the day they came out. Think about all the advisors that were big in that. They're not on the radio anymore.
Nope.
They're done because it was that bad. They used to call, what they call them before, biatical settlements. Everybody lost, it's the same thing. Everybody lost all their money in that. We can't use that name anymore. What are we going to call them now?
Life
Settlements.
That's right.
So, and that's what I tell people too, is if you have a financial advisor.
And now it may be Bitcoin.
Yeah, if they sell some of these crazy products, don't do them. They should always do registered product. Well, that's our show, folks. I want to thank everybody for listening. If you have any financial questions or you'd like to take advantage of a no-cost, no-obligation retirement plan, our number is 972-960-8700. Or 972-715-2424. Or go to ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.